Hi everyone, good afternoon. Today is Monday, February 11th. This is Alissa Coram here with Chris Gessel. And on today's show, we're going to be talking about how to trade index tracking ETFs and how to play Shopify ahead of its earnings report Tuesday before the open. But first, let's take a look at the major indexes. So we finished the day just moderately mixed here. The NASDAQ and the S&P up about 0.1%, and the Dow down about 0.2%. But overall, how are we feeling about the uptrend?
So far, the uptrend is looking great. In fact, it's doing what we have been expecting. So we've kind of pulled up to the 200-day moving average, and we're getting a little bit of resistance there. But overall, things are acting well. There's only one distribution day on the NASDAQ. That was last Thursday. And both the NASDAQ and the S&P are still above their 10-day moving averages. So that's a short-term measure that we just see on a very short-term basis. Is the market still trending higher? Is it showing strength? So that looks fine as well. Right. And the other thing is growth is looking pretty good.
That's right. We will be showing the IBD 50 ETF FFTY finishing the day up about 0.7%. So outperforming when you're looking at how both the S&P and the NASDAQ finished. And this is what we saw towards the end of last week as well. So growth seems to really be in favor right now.
Yeah, exactly. And that's what you want to see when the market is trending up. Growth stocks should be outperforming. So when that's happening, I mean, we're happy with that. Breakouts are generally working, and you can see how the FFTY, which is based on the IBD 50 index that we license out, it's done really well. And as soon as the market hit bottom, it started rallying, and it's up about 25% versus about 15% for the S&P 500. And that, raises another point. How do you deal with indexes? And indexes are different than stocks because indexes are being rebalanced. If something is, not performing, especially in the case of FFTY, it's rebalanced every week.
So when we're trading growth stocks, we're looking at the charts and we're looking for breakouts from bases. So you have to think about this differently then.
Yeah, it's more of a reversion to a mean. So we wouldn't tell people go ahead and buy off the bottom on growth stocks because you don't know what's really going to happen. But with indexes, it's a little different. And so when they do sell off and you see a reversal from the market, that's usually a good time to start making a purchase. And if you're a long-term index investor, it's actually the best time to be making a purchase. And really, the worst thing you can do is to try to trade an index like a stock, where you're selling on weakness and buying on strength. It's turned around really, especially on a long term. You don't need to sell. You just need to buy on weakness.
And this is a strategy that's really paid off on Leaderboard too, right?
Oh, absolutely. Well, when the market hit bottom on the day after Christmas, right away we know that it takes weeks before breakouts start appearing, and so we did not want to lose ground versus the S&P, and that's why we put on a double position of UPRO, which is a triple S&P 500 ETF, and that just gave us the cushion and the leeway to be more choosy on buying breakouts rather than just trying to grab some stocks to get exposure to the market.
All right, well, again, a strategy that's definitely paying off, and another strategy that pays off is when you look at earnings option plays for stocks like Shopify. We're going to have earnings before the open tomorrow. Strong growth expected on the top and bottom line. So heading into this report, how should investors be looking at the Shopify trade? It attempted to break out today. Didn't do so well. But
well, it pulled back, and that's not surprising given that it's the day before earnings. Now, one thing about this stock is it's rallied about 50% off the bottom of the base from December, and so it's somewhat extended. However, if earnings are great, we could see a big gap up. So again, we typically have two ways that we handle earnings. We either buy an option, or we just play the gap up on the morning of the trade. And so in this case, we opted to go for the option. But what was a little bit different, normally we're doing very short options, like a weekly option, maybe have 5 days until expiration. In this case, since the stock is extended, it may bounce around a little bit. We wanted to give ourselves a little more cushion, so we opted for a March 15th option with a strike price of 180. This is a little more expensive as a percentage of the stock price than we normally talk about. It was 6.2% of the stock price. That's still less than the 8% that you typically want to risk on a stock trade.
Right.
So,
but when you're putting that in perspective of the Leaderboard portfolio, it's even less risk.
Yeah, absolutely, because we put this on as a half position, so that 6.2 or 6.4 becomes 3.2, and when you think about what constitutes a fully invested Leaderboard portfolio, that's 8 stocks. And so as a half position, we're really only risking 0.2% of this on this option in terms of the overall portfolio. So for us, it was a very easy decision. The risk-reward ratio is great. If we lose 0.2%, it's not the worst thing. But if this stock, which has essentially been going sideways since March a year ago, because it was a base next to a base, even though it says it's a 5th stage base, to me, it's a 1st stage base. It's had long enough consolidation. So if this thing really takes off, then for a very small portion of money, of risk, you set yourself up for a good reward.
Well, a compelling trade here and compelling fund sponsorship as well. We have Fidelity, Contra, Magellan, OTC, and Balance, as well as T. Rowe Price, New Horizons. So fund sponsorship also important in the context of looking for the best stocks to buy.
Absolutely. I mean, we always start with fundamentals and then look at the technicals, but then the next thing we look at is what is the fund sponsorship? What kind of funds are in this stock? And these funds that you just mentioned, we refer to them as Bill funds. These are Bill's favorite funds. He knows the managers. He's worked with them for many years. These were always the funds that if they were in a stock, he felt pretty comfortable about being in the stock, and so we use the same approach.
Yeah, and it's really paid off if you look at when some of these funds are adding to their position and how long they're holding them, and seeing stocks take off in tandem with that. That's what we've seen through history. All right, everyone, thank you so much for watching today. Hope you learned something great. We'll be all eyes on Shopify tomorrow morning, and in the meantime, make sure you're heading to investors.com for all the latest stock news and analysis. This is Alissa Coram and Chris Gessel, and we will see you right back here tomorrow morning.